Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello, and welcome to another episode of Dividend Discussion here on Dividend Obsession. I'm your humble host, Troy, and today I have the pleasure of speaking with Rusty Ram 78, aka Russ Knopf from Twitter. Russ, go ahead and tell the people a little bit about yourself.
Hey, what's up? Troy Destroy. Thanks for hanging out here. That's a little bit of psychobilly humor. I'm pretty sure you're not into mid 2000s psychobilly music. So, with that being said, well, I am. By the way,
I
we'll
didn't
move
know that
on.
was a
But
genre.
yeah, it's gothabilly, psychobilly, the Necromantics. They're one of my favorite psychobilly bands. The wife and I love them. But
Wow.
anyway, what's going on, everybody? And Troy, thanks again for having me here. And yeah, my name is Russ. I have a dividend investing channel called Dapper-Dividends. Started it right during the pandemic in April 2020. And yeah, I don't know, just talk about dividend investing, things I'm learning, things I'm doing right, doing wrong, sharing that journey. And dude, working my way to being a millionaire, at least a net worth of $1 million is kind of the trajectory we're on, trying to be directionally right instead of precisely wrong about certain things. So that I do know is how we're getting, and we can get into it if you want to know how. Yeah. So you know what, real quick, I grew up in Chicago, in the suburbs, the close suburbs, lower middle class. So had no financial education whatsoever. So this has been kind of an interesting journey that I've been on. And I really didn't start getting into this stuff until I was about 40, which is crazy. That's too late. So for you being so young, this is super motivating to hopefully share some information and hopefully get some other people on the right track to not working for the rest of your life and being a cog in the wheel.
Yeah. Yeah, I congratulations on getting started, and you're almost at the net worth $1 million. So that's very cool. Do you have goals? Like, is your first goal the net worth 1 million? Because I'm in a race with my cousin for the same thing. First, we're gonna see who gets the net worth million, but then after that, I want to be like the asset 1 million. As far as like, I want to subtract the car. I mean, my car is paid for, but I want to be able to subtract the mortgage and stuff like that. Is that the next goal after that, or what's your goal after that?
Yeah, so actually, as I'm becoming to be older, well, every day we're older. That's silly. Is to just be happy first and
Yeah.
foremost. Like, I've heard so many people, especially like everybody that watches me knows I'm a huge fan of Warren Buffett and Charlie Munger, and they talk about knowing billionaires that are lonely and miserable and unloved. And so the first thing that I'm learning is like you can have literally billions of dollars and be miserable. So I think for me, like being happy is the first thing. And I've done things in the past where I've cut too deep, like, I've saved too much money at the point of sacrificing a little bit of happiness. So yeah, but $1 million really is, you're not going to, that's going to be nothing. And the way that inflation's going, like $1 million 10 years from now ain't going to be what it is right now. Whole time value of money and time decay and all that. But honestly, that's the first waypoint. And I don't know about you, but do you find that you have to have those little goals that you celebrate along the journey? Like you can't just wait until the final destination to be, and even if, as I say that, dude, I have a tendency to ramble. So just cut me off if you need to, but
No.
it's the final destination, honestly, is when you're gone, when you're expired, when you punch your time card to clock out of this life. But it's an infinite game in business and investing are games with, you're either ahead or behind. There's no win or lose, I think. And I don't know. What do you think about that, Troy?
Yeah, no, I agree. So, I mean, I relate that kind of to, like every day when I try to grow as a person, as an individual, like I either always say, cause I'm a competitive level power lifter too. So I always say like, I either get better or I've gotten worse, which is exactly what you're saying. There's no staying where you are, because at the end of the day, whether you're competing with yourself or competing against or with others, if I stay still in my strength and my passion towards powerlifting, somebody else that was a little bit behind me got a little bit better. So now I don't have the same lead I used to, or maybe they overtook me. And same thing in investing. If you want to go out and, like you say, enjoy life a little bit, that does come at a sacrifice towards what, because like at the end of the day, if you spend $7 on a Starbucks coffee, first of all, I appreciate you because I own Starbucks stock. Second
Same.
of all, that $7 that you spent today, 30 years from now, that $7 is worth a lot more. And 30 years from now is when you need that money. So it's all like, hey, is the $7 I'm about to spend today, is it worth my happiness that I'll get right now? Or is it worth more to me later? So it's kind of one of those things. And I agree with you. So, yeah. Okay. So first question for you. I want to know, you spoke about this a little bit already. So when did you begin your investing journey, and what got you specifically into dividend investing?
Yeah. So as an investor overall, and I don't really count this, I don't know if you count it, but when I started at a job in 2003, they had a 401k that they enrolled me in. Didn't even know what I was invested
Yep.
in, where it was at. I think I had like 1 or 2% going into it. So technically, I was an investor. I mean, my brother-in-law doesn't care about the stock. Dude, the stock market could go away tomorrow, and he'd be like, whatever. But he's an investor. Like, he has money going into a 401k. So,
Yeah.
I don't really think of that as being an active investor, I
Yep.
guess, and really trying to take control of your financial destination and put your financial journey, right? So I'd say it was right around 2018. I had just decided one day, like, you know what? I think I'm going to be an investor and just make a lot of money, and I'm going to figure this out because other people do. And I found Robinhood, right? I wanted to start buying stocks, and there was like Scott Trade, and Robinhood really wasn't that well known, so kind of stumbled on it by a Google search. And dude, I was like, yes, this is for me. If it's free, it's for me, we like
Yeah.
to say
Yeah.
around
Yeah.
here.
I like
So
that.
yeah, got onto Robinhood and went right into trading in penny stocks because obviously I've heard other guests on your show say you can buy a lot of them. Like, why am
Yeah.
I going to buy one share of Johnson and Johnson at like $99 or
Yeah.
100, whatever it was? Dude, I could buy this, biopharmaceutical company that says they want to cure cancer and solve all the world's problems, and you could get 100 shares for, $1.
Yeah.
It's like, yeah, but that doesn't work out so well. It's so
Yeah.
much harder. And the reason like the penny stock game is tough is because it's so manipulated because people can buy and sell so many large shares in such a short amount of time. But yeah, that didn't work out. So I lost a lot on penny stocks, and then found swing trading. I was like, all right, I went on Udemy, found some swing trading courses that I took. So I started my swing trading career. And in the process of doing that, I did a little bit better. But as I found out, dude, I am terrible at not getting married to your investments,
Mm.
which is still something I'm working through right now. But as we see that it turns out when you are a dividend investor, you get rewarded for inactivity, for buying and holding and doing nothing. And it's
Mhm.
pretty boring. It can be boring. The times I try to make it exciting is when I usually, as I call it, fiddle with the knobs, is usually when I get bit in the butt, and things don't work out. But yeah, man, it didn't work out with swing trading because I would hold on to things way too long. As soon as I was looking at the charts, they call technical analysis. As soon as I was supposed to sell or dump something, I never did. I held it. I'm like, I want to keep holding this, even though it's going down. Violated the rules, they call it, and that didn't work out. So one of the stocks at the time was Neo. I don't know if you remember.
Yep. The
You guys know
Chinese
Neo.
electric EV. Yep.
Yeah, so they were being called the Tesla of China. In September of 2018, they IPO'd. So I bought, a few $100s worth. I'm like, sweet, the Tesla of China. I'm going to buy them. And they started doing really bad. They did an initial pop and then the drop and just kept dropping. And I kept adding and adding and adding. And it got to the point where there's an app called StockTwits. And I don't know if you ever use StockTwits, but it's degenerates. It's a bunch of degenerates talking investing. And it's mostly for traders, I guess, not so much investing. But yeah, pre-market opens around 4 a.m. here in Chicago time. And I would wake up. I would be so worried because I was thinking if the stock goes up, then I can sell and I can get out and it would just go down. So I'd be put it this way, Troy, I lost sleep. I started waking up at 4 in the morning, losing sleep. And after about 3 or 4 nights, I was like, dude, I was so tired. I'm like, I just can't go. There has to be a better way. And to, I guess, cut to the chase here, my grandfather did some investing and I never really talked to him about it. And I remember him mentioning once that he liked Walmart because it paid good dividends and AT&T paid good dividends, which is another story in and of itself. But yeah, so I started going down the Google rabbit hole. And as I say, I was like Alice in the rabbit hole. I went down, I still haven't come back up. And, it could be a little bit of a Mad Hatter's Tea Party around here at times. But hey, I'm learning, I'm growing, I'm sharing on the channel. And that's what started it. Just thinking about what is this dividend stuff. And yeah, that's. Oh, and by the way, when I was swing trading, I also had received dividends from United Health, which I was swing trading, and I got out of that one. I think I'd bought 10 shares somewhere in the 200s, and now it's like 500 something a share. So it's just like, if I would have just held, see, I'll let you talk after this, but this is what they say. They say that in Wall Street gets paid for activity, meaning when people are buying, selling, moving in and out of the market. But long-term investors get rewarded for inactivity. So for me, being inactive and finding a stock I really like and holding on to it indefinitely fits me like a hand in glove. So that's kind of the rather lengthy answer to how I've become a dividend investor.
No, I appreciate you telling me all that. And the thing that I always get out of this is I think, I don't know, you're my 16th, 17th, somewhere around there interview. Nice. I think there's only been 1 or 2 people that say that they started with dividend investing. And like, it's always fascinating to me to see how, like, the journey of winding roads that people go down to be like, you know what? It turns out if I don't touch things work better. So it's kind of like, I told this story before. I don't know if you're familiar with it, but I started with Robinhood. I actually opened Robinhood probably also back in like 2018, maybe even before that. I feel like Robinhood was a thing for a while, but like it wasn't, like you said, as popular as it is now.
Yeah.
And I remember opening Robinhood and I typed in, I don't know, it was like Apple or Nike or something like that. Cause like I had an iPhone and I always wear Nike. So I was like, okay, let me search these. And then I pulled it up and I saw the ticker. Let's just say it was Nike for $100. And I was like, okay, I like this, but I have to spend my real dollars on this. That's scary. Like, I don't want to do that. So then I closed the app. I deleted it. I was like, okay, I'm not going to do that. It turns out I should have done that, but I didn't do that. And then I remember it was during COVID. I was watching like Andre Jick and Graham Stephan, like those finance YouTubers. And that's what kind of got me into this. And I remember getting the free stock from Robinhood when you signed up. I did my little scratch off and it said Sirius XM. And on Sirius XM, they pay a 1 penny dividend. And I remember I just had my phone in my pocket one day and I got an alert on my phone that said Sirius XM is paying you 1 penny in dividends today. And I was like, what is a dividend and why are they giving me money? I was like, is this a bill? Like, do I owe somebody something? Like, what's going on? And then I started, like you said, I went down the rabbit hole and here we are. Like, it's crazy how one little thing is what gets you into dividend investing. And you and nor I are here to tell everybody that dividend investing is for everybody. It's going to work 100% of the time. Any investing style can be horrible for any one person.
You know what it is, dude?
Go ahead.
You got that first taste of passive income. Yeah. And as I've come to find out, dude, passive income is a hell of a drug.
It is. Yeah, well, that's how people end up getting into a lot of the problems with dividend investing too, is because you're like, okay, I'm getting this money passively. How can I get more money passively with less of my money? Then you get into your yield stuff where you're like, oh, let me go get this 37% yield stock. Or I remember when Zim was all the hype, when everybody was like, oh, shipping containers, this is the thing. They paid like a 55% dividend or whatever. And I was like, guys, like, I think right now I just saw a video. I think they're back up to like 147% dividend yield, because their stock price keeps dropping.
I think they eliminated the dividend. I'm pretty sure they eliminated their dividend.
Okay,
That happens with a lot of shippers, is that they're very cyclical.
Yeah.
And when times are good. But when things pull back and they hit the bottom of that cycle curve, it reminds me of like TSLY. When I see people with TSLY, I don't know if you invest in it.
Nope.
I hope it works out for everyone. But for me, it just reminds me, it looks like a bunch of junkies trying to get a bigger hit, and it's like telling themselves like, no, we can handle this. It's going to be okay. And I'm like, we'll see. 60% yield, whatever it is now. I'm like, that I don't. everybody would be on it if it was sustainable and they weren't. I suspect that they're returning a portion of the investor capital back to them, which is why the share price and the net asset value keeps declining. But I haven't really dug into it all that much, so I mean that
I
may
have
not be accurate. But
I did my best video on the channel is actually a yield max review, and I didn't do it to like put a yield max down. I quite literally was like, I'm hearing a lot about this. Let me do my own research, and I'll just record it and see what happens. So I did that, and that was, like I said, my best video, and my point was just like, hey, the question I instantly asked myself for TSLY, is it better to own TSLY or just Tesla, or APLY or just Apple or Microsoft, or whatever the underlying thing is? So that was that whole video to find out which one was better. I'm not going to do any spoilers. And then I did other videos where I call it the core four, which is your Apple, Tesla, your Nvidia, and your, I forget the other one. The ARK fund are the core four. Like those are their first four funds. So I did a review, and this is just recently. I just finished the mini series that I did, where I was like, okay, we already know the results of TSLY versus Tesla, but now I want to know if you are at the stage of your journey where you do need dividend income and you can't wait for Visa's 20% dividend growth rate to catch up. You need the money now. It's like, okay, pretend that's the case. Are there better options than these? Are these just like the flash in the pan, or is there something that's not only going to make you income, but also preserve your capital? Because that's important. I always say thousands of times here on the channel that a lot of times with these higher yield stocks, they're like, hey, here's $75 in your left hand. Don't worry about the $100 we lost you in your right hand. And that's what people are just like, every time you start to look at the right hand, they're like, no, over here, the left hand, here's some more dividends. And I'm just like, if you need that, if you're at that point in your journey, that's fine. That's okay. You're retired. You need the passive income. But in my case, I have 22 years until I hope to retire. Like I want to retire by 50. So if that's the case, I don't care what my dividends are today as long as they're growing, because I don't need the $80 I might make this month or the $120 I might make next month. I need that money to be big when I need it. So that's kind of, I mean, I did like I said, if you want to watch those or anybody else is interested in that yield max stuff, I encourage you to check that out. Cause like I said, I didn't attack it from a point of view of like, let's crush this thing everybody's rooting for. It's kind of like, hey, one, I want to know what it is. And two, are there better options if they're out there?
yeah, I mean, just on the simple face of it, like with TSLY, I mean, Tesla doesn't pay a dividend.
Mm-hmm.
TSLY is selling options, and it's tied to Tesla, and it's got a 55% yield. So it's like, where's that coming from?
Yep.
If I was to invest, I would need to know exactly where all of that was coming from and how that was being generated. And I think a lot of newer investors fail to do that. They don't take the time to understand the underlying and where things are coming from. But yeah, man, it's but that's the journey. That's part of it, is you got to learn. People are going to make mistakes, and hopefully you just don't repeat those mistakes, because the first time you do something and it's a mistake, but the second time you do it, it's a choice.
Yeah.
So that's why it's kind of a free pass the first time you make a mistake, and you can't beat yourself up too much about doing something you didn't know any better on.
Yeah, I agree. Hey, you're doing a great job. This is unscripted. You're doing a great job of doing the segues for me, so I appreciate that. Yeah. Next question is, what is your biggest dividend related mistake? And more importantly than the mistake is, what lesson did you learn from that mistake to make sure you don't make it again?
Yeah, if it would probably be AT&T, just buying it because everybody bought it. It's the old, the stodgy old blue chips dividend stock, and it's just always going to be there. So I went pretty heavy into AT&T and really didn't understand the fundamentals of the business. And there's a reason why Warren Buffett and a lot of super investors don't hold telecom stocks for the long term. And it's because they're highly capital intensive and highly competitive. Those are two kind of no-nos to, put it this way. If you pull up a chart, a total return chart, meaning dividends reinvested, and you do even 10 years, and you look at AT&T, and you look at Verizon, and you look at T-Mobile, I think AT&T is down like 2%, negative 2% with dividends reinvested. I think Verizon is at about 20% return. And then T-Mobile is at like 400%. It's ridiculous. It's multiple hundreds of a percent. And they have never paid a dividend. Now that's changed. They're about to start paying it. And it's silly because I remember their old CEO, which his name escapes me, but I remember him calling, because it's one of my favorite movies. He was calling AT&T and Verizon Dumb and Dumber. So now it's like, want to join Dumb and Dumber.
Yeah,
You
Dumb
know,
and Dumber and
so
Dumbest or something. Is that where?
yeah, to
Yeah.
anyway. Yeah. So I don't know. It's buying AT&T, not understanding it, and then even as kind of being sold a spin job. When you listen to CEOs, people, you always have to take what they're saying with a grain of salt and really look into the past what they're saying, because CEOs really got to that position because they're really, really good at selling things and putting a spin on things, and kind of ignoring the bad things and not really like downplaying the bad things, and
Mhm.
then anything that's good just like way up talking and upselling that. So they're really good salesmen. And I guess John Stanky, kind of got sucked into him. And it's funny, one of the things, he's you almost forget and you think like, well, Randall Stevenson was the CEO that preceded him and was at the helm when they acquired Warner Brothers Discovery, which has been just awful for
Mhm.
them. Awful. But John Stanky was in upper level management. Like he was one of the people that helped orchestrate that. So it's like, they don't tell you that kind of stuff. And you kind of have to see through what they're saying through the smoke. And it's like, dude, like you were part of that. Like what, you don't get a pass. So and I'm still holding AT&T, and I'm stubborn. I told you, I'm waiting for them to come back up to the mid to low, not mid to the right around $20, 21, 22, and I can get out. I don't know if they'll be there, but that's been one, is just buying something because everybody's bought it. And traditionally, they had been a solid dividend paying company, which, what is that saying? Past performance is not indicative of future results. Dude, exactly. The past is not guaranteed. The past, the future can rhyme with the past, but the past tells us nothing about the
Mhm.
future. One of your past guests, which I kind of push back on, is Harris Elliott, good friend of mine, become good
I
friends with
like
him.
this
He
little,
uses
get the beef in there, Russ. Get the beef in there.
yeah,
Tell him.
yeah. Well, we can talk about him. I threw out some salacious rumors on Dave's podcast that Harris will go into Costco and he'll get a hot dog and he'll lie down in the bathroom and eat his hot dog, take his shirt off and stare at the ceiling tiles, which is really bizarre. And the look on your face,
That is weird.
exactly.
Yeah.
And that's why I like to say weird and strange things. So, but what I push back on him about is his dividend yield theory, because when we look at, the dividend yield of this whatever company was 3.5% the past 5-year average, and now it's at 5%. That doesn't tell us anything about the future. That just shows us where we've been. So, dividend yields sometimes go higher because the companies are paying a higher dividend, but sometimes they go higher accidentally because there's something wrong with the business, like a VF Corp or a Walgreens or
Yeah.
a Dollar General. There's something going on that's pushing that dividend yield higher, and we got to use that as like a red flag. And that's one thing also I've learned, is a dividend yield going higher, not because a company's paying a higher dividend, is because there's something fishy. There's a red flag. So that should mean, hey, slow down and investigate, and don't just rush in and buy a high dividend yield, because you could get burned.
Yeah. Yeah. Well, and that's one of the things that I like what you said. And like, I was just trying to think about that, is a lot of people, when they first start, especially when they identified that they want to be a dividend investor, their next option is like, okay, I want to buy things that I've heard. I've heard that thousands of times. I want to buy the Johnson & Johnson, the Procter & Gamble's, the AT&T's, the McDonald's, the Pepsi's, all those things. And that's a good place to start. But you like, the more filters, and they don't need to be complicated filters. They need to be broad filters that can really narrow down. For example, my filtering for my stocks is really 3 things. I might add a 4th in there, but I'm hesitant to do that. The first one is a dividend streak of at least 5 years, paying and growing, because that's showing me that not only are they able to pay, but they're able to forecast that they can continue to pay for long periods of time, which is obviously good. And then I like a outperformance of the S&P 500 over the past 10 years. And to exactly what you're saying, no guarantee that that's going to extend into the future. But what I always say is, would you rather own a company that has a history of outperforming over a long period of time, or a company that just promises to do so in the future? Show me that you know how to do this and you can continue to do it. And versus saying, oh, AT&T, oh, we're going to outperform next decade. Sure you are. Like, you haven't shown any like knowledge to be able to do so. And then my last one is, personally, I don't really care about yields yet, because like I said, I'm really far away. I like a dividend growth rate above 10% for the last 3, 5, and 10 years. So it's growing. The fourth one, if I had to add, would be a payout ratio under like 50%. Just because in order for them to continue to grow that dividend, it needs to be, a lesser part of their cash flow. So, but all that to say, the point of what you were saying about like these very popular stocks, you can't just say, oh, it's a dividend king, or oh, it's a company I heard of or I use or whatever. Like there needs to be something else. And those something else's don't need to be so complicated. You don't need to die. If you are just getting started, you don't need to learn about all the different kinds of cash flows and balance sheets and all kinds of stuff. Like that is a good thing to get to eventually. But you need to have simple stuff that not only you can follow, but you can understand. Because at the end of the day, if you're just trying to throw a dart at a dartboard, you might be right, but more than likely you're probably wrong. So I like what was that quote that you said earlier? You'd rather have something about like a precision inaccuracy versus like a guided correctness. What was that? I butchered that.
Yeah, no, it's about being directionally right instead of precisely wrong.
Boom. Yeah.
Yeah.
Hey, that was a pretty good interpretation. No, I was pretty close.
Yeah, and it's funny. I heard you throw in the accounting there, and it makes me think of like accounting is pretty much the language of the financial market, and you got to have some knowledge of accounting, and I'm trying to get better at it. I'm not an expert. I think I can hold my own. I'm always learning and trying to improve. But if you have no interest in learning accounting, then you're always going to be subject to the whims of the market, and you're not going to be able to understand if a business is being sold off and if it's still a good investment and you should be into it. Like I've done with one of mine, Nexstar Media. That's when I just hit 100 shares on. The market doesn't like them right now, but I think they're missing a lot of things, and I'm pretty, putting my money where my mouth is. Hopefully, it's not going to be a boondoggle, but yeah, and that's a bad thing to say. Like, right? Hope is not a strategy. We can't be using hopium around here. But you got to have some hope and belief in yourself. And if you don't have any desire to learn accounting, then I think ETFs are the way to go. Just don't even bother. Because then, like you said, dude, you can totally use that as ideas. And I know everyone likes to quote Peter Lynch as saying, like, invest in what you know. Like you see Procter and Gamble, dude. Procter and Gamble's all over my. It's like it's almost to the point where it's like a horror movie. Anything I turn over in the bathroom, there's a great chance it's going to have that P&G logo on it. I mean, I'm to the point where I'm even checking my wife for a P&G tattoo because it's like some dystopian future where they're just everywhere. Yeah. But yeah, you can use that as an idea to look into a business. Obviously, my example is Blockbuster Video. Dude, we lived in Blockbuster Video. Everybody went to Blockbuster Video. It was always packed, and they went out of business. They went bankrupt. Well, I don't know. I guess there's still one up in, I think, Alaska or Utah or somewhere.
Yeah, it's Alaska. I don't know if they ended up closing that one or not. I remember hearing something about like that was the last remaining location, but I thought they were going to be closing.
Yeah, I think what happened, and don't quote me, they may have went bankrupt, kind of like Bed Bath & Beyond did, and then they had their name bought, which Overstock, Overstock.com bought Bed Bath & Beyond's naming rights out of bankruptcy, and then they changed Overstock.com to Bed Bath & Beyond, which is really bizarre, but yeah, it's exactly Bed Bath & Beyond. Maybe people love shopping there. It's so you can use it as an idea to look into something as an idea generation. But again, I'll wrap that up with Peter Lynch saying, if you are going to buy one stock, if you're going to buy an individual stock, you need to spend at least as much time looking into that stock as you would a new refrigerator. So if you're not going to do that, just ETF it, make it easy. Hit the easy button. Just, what do they say? VTSAX and chill. I think it was one of the popular ones the kids are all talking about nowadays.
It's the crazy thing. I think I was just listening to something that Warren Buffett was in the other day, and he was just basically saying that when you are buying a stock, pretend you disappear or go to jail or something for 10 or 20 years. Like you want to know that you're going to buy that stock and you're okay with holding it for that long. It's just like, think of it like your house, your property that you own is a stock in a way. It's a piece of real estate. So you're buying it and you're not buying it to like, oh, okay, next week the market's up a little bit, I'm going to sell a part of my house. Like you don't do that. You're just like, okay, that's cool. I'm going to continue to hold because you bought that house for a reason. You like the area, you like the school district, you like whatever. So you did all that research, and stocks are no different. If I want to buy Apple, I'm not buying Apple because I want to get rid of it next week. I'm buying Apple because I want to hold it for a long time.
Yeah, and that's the way too. That's the correct thought. And Warren actually has two things he says, and just you're close. You're directionally.
Yeah, there we go.
Is that he says you have to think of it as if the stock market were to close the day after I bought this for 10 years. Would you be okay holding it knowing you could not sell that for 10 years? And if the answer is no, you probably shouldn't be buying it.
Yep.
And then he also has another example called his punch card example. He says, if I gave you a punch card and it had 20 holes on it, 20 slots, and every time you bought a stock, you punched the slot, you could not buy any more once that was all filled up. He said, you would really think long and hard about before you bought a stock, because you would know you only had 20 shots. And it's, he obviously doesn't adhere to that because they've bought and sold way more stocks or hold. Well, it's different, right? They have their wholly owned businesses, and then they have the marketable securities, meaning the stocks that they invest in that are on the stock market. They're marketable. But yeah, as far as Warren goes, I love him, dude. He's one of my favorites. And, the guy is just, I could listen to him all day, quite honestly. I find great inspiration from him. But still, he's not perfect. He's not the be all end all. I know they call him the Oracle, but one thing I've learned is that even the Oracle of Omaha does not know what's going to happen. If you're watching this, know that nobody knows what is going to happen tomorrow. We have good guesses. We could be, again, I don't want to, I'll use it. We could be directionally accurate, but that's, we don't know what's going to happen. So that's Warren. Hey, Warren also tells me one of my favorite quotes. I got it hanging up. He says, if you don't find a way to make money while you sleep, you will work until you die. And I was always like, damn, that's powerful. I printed it out. I've seen it every day for years when I leave the house and come home from the house. But the guy's working until he dies. He's literally going to be at Berkshire until he dies. So I think the caveat, meaning that he loves it. He says he feels like a painter, like Michelangelo painting the Sistine Chapel. He says he just really enjoys what he does every day going into work. So I think it's meaning that if you don't learn to make money while you sleep, you may have to do a job that you don't like doing because it pays more money. So that's good old Warren. Where would we be without him?
Yeah. So this is off topic, on topic. So I'm a big Thunder fan. The Thunder's GM is Sam Presti, also known as like one of the best GMs in the league. He just had his introductory press conference for the season, and he speaks for probably too long. He spoke for like an hour and 50 minutes, like just going on and on and on. So one of the things that he said, which I wrote these things down because I was like, I could probably use some of these for the channels or the interviews. He says, this is going off exactly what you said. He goes, there's two types of forecasters, those that don't know and those that don't know they don't know. And I was like, that is so, like, there's so many, whether it's a YouTube channel or CNBC or wherever you go, somebody always pretends to have the answer. The stock market's going to do this. We're going to have a recession to start 2023, all these things. Meanwhile, the NASDAQ's up 38% this year, all kinds of stuff. And like, that's at the end of the day, these people, guys or girls, they can be educated, but nobody knows. Like, they're making educated guesses based off information that they have, but there's also information that they don't have that can flip exactly what they just said. So when I heard that quote from Sam Presti, I was like, holy crap. There are two types of people, those that know and those that know they don't know and those that don't know they don't know. And I was like, that's it right there.
It sounds to me like he kind of ripped off Howard Marks. I love Howard Marks, by the way. He's an old investor, Oak Tree Capital, but he has a very similar saying that goes, it's not what you don't know that hurts you. It's what you think you know that ain't so. Yeah. So it's very similar, dude. It's different varieties of apples. Yeah. I don't know my apples well enough. I was just going to spit off Macintosh or Granny Smith. They're both apples.
I like Fiji. That's my favorite apple. They're very sweet. They're smaller, but they're good.
All right, we're going to start an Apple Apple channel now.
Yeah, there we go. Okay, so next question for you. So, I mean, you kind of spoke about this when I asked you when you began your investing journey, but how has your investing style changed? Let's just start from like when you first started dividend investing to now. Like, what do you do different?
Try to follow the crowd a lot less. And it's cold, dude. It's cold outside of the crowd, outside of the herd. But like what we talked about, the herd doesn't know what's going to happen. So just because there's a societal trend or the crowd thinks they're right about something, like I'll tie it into my next star media. They really took a beating when Disney and Charter had their kerfluffle. They had a court case that just got settled with DirecTV. People think that they're a melting ice cube because they're the nation's largest broadcaster, but I've really looked deeply into the business. And for me, it's just trying to find those businesses that I really do understand. And that's something I haven't done in the past. That's where I've really changed, is like when I bought AT&T, when I bought Intel, for example. Intel is a popular one, still holding 100 shares I'd like to get rid of. But dude, I don't understand what gives Intel their competitive advantage. I understand they make chips, but if you if you show me an Nvidia chip, an AMD chip, and a Intel chip, and you say, explain to me why one of these is superior to the others, I'm like, I don't know. Like, and that's me being honest. Like, and
Yeah.
I know there are people that know, but for me, and again, to quote Warren and Charlie, they have a too hard pile. So I didn't have a too hard pile, but now I do. And I had started a position in NEP, Next Era Energy
Hmm.
Partners, I think is what they were. They were like an offshoot of Next Era Energy, or a subsidiary, I think, of Next Era Energy. And I'd started a position because a couple people on Twitter were talking, but this is kind of when it started. Um, it was, I think, February. It was cold out of maybe 22. I was looking into it more. I was like, so they make money from energy, from real estate, from, I think they even had like mortgage loans in there. They had business loans in there. They had a couple other things. I was like, I don't really understand exactly how they're making their money. That's giving them a durable competitive advantage.
Hmm.
And I ended up selling it. I mean, it was quite fortuitous because that whole utility set. Well, I mean, we could get into why the utilities have taken them, and the consumer packaged goods stocks, they've all taken a hit. But either way, we won't get too far ahead of ourselves. Is that not fully understanding why I should be invested in a business? And, I look back at some holdings I still have. And one of them, I'll be honest about, like Lockheed Martin. I bought them because I know they're the biggest defense contractor. I was like, cool, I'll buy them. I bought 10 shares over a period of time. I still hold those 10 shares, but right now, gun to my head, I cannot tell you who the CEO is, who the CFO is. I can't tell you every division that makes them money. I used to know that at one point, but they're literally just a ticker symbol that I look at the price action on now, and that's not good.
Hmm.
That's not good. So that's one of my faults. I'm trying to, but I have such a low cost basis on them that it's probably going to be okay.
So how do you that's a really good point. Me being the type of person I am, I often I call it like, the informational paralysis kind of thing. So how do you balance like wanting to know a lot about a company and then like never pulling the trigger? How would you balance that?
Yeah. Say that again, because I was thinking, dude, see, this is my one track mind. I was just thinking, I was so proud of myself because I had to clear my throat there and I turned the mute on, and I was thinking, like, damn, that's really
Yeah,
professional,
that was
man.
good.
Nice
Yeah.
job.
Yeah.
And I failed to pay attention to what you were saying. So
No, no. Okay.
my
So
arm hurts from patting myself on
yeah,
the
no, that
back.
was
So go
good. Yeah.
ahead.
I know if I like, see, the good thing about this thing that we're recording on is the mute and the end call are the opposite sides. Most of the
Yeah.
time, my like pause and stop are right next to each other. I'm just like, I'll just cut it out in editing. Like, I'm not worried about that. Okay. So the question
Okay.
was,
Back on track.
yeah. So the
Yeah.
question was like, I do the informational paralysis thing where like if I dive, not necessarily stock by stock basis, but like if I have an idea, there's a reason a lot of my ideas that like either subscribers have given me on the channel or I've thought of on my own, I just write them down because it takes me so long to do the research because I'm always like a rabbit hole where I'm like, okay, this, but I'm like, what if I do this? Or like, what if I change this? So same thing goes with stocks. Like, how do you balance understanding enough about the business to start a position and like not, and basically not limiting yourself to like, I need to know everything about this business before I invest and like missing an opportunity? How do you balance that?
Yeah, it's kind of a two-step process. So if somebody gives me an idea or I come across something, I look at like Simply Safe Dividends. I like that site. I'll look at, just like you said, just the really surface level metrics, like their cash flow, their earnings, their profitability metrics, the cash flow metrics. How does that all look? And I kind of have that really quick, like 5 minute screen. And, like dividend history, that plays into it. I've tried to train myself to look at the business first and the dividend second,
Mhm.
because it used to be look at the dividend first and the business second, sometimes a really distant second, which is absolutely bonkers
Yeah.
because the business is what's paying the dividend.
Yeah.
So if the business is bad and they can't continue to pay that dividend, why the hell are you buying a bad business? And that's what we can forget is
Yeah.
that when we buy a stock, we're buying a little piece of that business. It's literally buying and becoming an owner of a functional business. And a lot of people just look at the ticker or look at the logo and buy it. And, so if it looks good, I'll buy like one or two shares. If it also doesn't look egregiously overvalued, I'll buy a share or two shares. And then I feel I got skin in the game. So then I'll dig into the annual reports and I'll listen to the last couple earnings calls. One trick I like to do is it's fun to listen to an earnings call from like 2 years ago and hear what they're saying about the future. Like if they're saying like, yeah, we've got this cooking and in 2 years we're planning on being here or doing this. So it's kind of cool because we always want the immediacy of now. We want to listen to like now. But if you go back into history, you can hear some management teams that are way wrong about where they thought they'd be 2 years ago. And it's like, okay, so should I believe them now? They're saying all these great things about 2, 3 years from now. Like,
Mm-hmm.
so
That's a good point.
that's kind of it. So it's management, it's the business if I understand them. And that's kind of why I ended up selling NEP. And a few people, I remember I put it on Twitter, like, oh, you'll be sorry. And it turned out to not be, but I was like, I may be, but I don't want to stay invested and own a business I don't understand. Like, don't you think that would be insane if you had a friend that's like, hey, so I run this side business, you want a piece of it? This is what we do. And you're like, yes, sold.
Well, that's already too far. Like him telling you what they do is already too far for some people. He's just like, I run this side business. He goes, here's some money. Like that's what a lot of people
do. Exactly. So you're just remember that for you, dear dividend investing viewer, when you buy a stock, you're buying a business that you now own. So it's kind of cool to think of it that way. And that's why AT&T, I keep coming back. I was like, this is not a very good business long term. And the most striking example, and I challenge any of you to do this, you can do it, I think, for free on Seeking Alpha, is to pull up a total return chart and go back 10 years. Total return is all distributions, dividends, everything paid, and it's negative. Yeah. It's a negative return. Dude, you've lost money.
You would have been better putting your money in a savings account.
I think it's 2%. It's not 20. I think it's negative 2%. So think of that. If you put $100 into AT&T in 2013, that $100 is now worth $98. That's not very good.
That's insulting.
It's terrible, but you don't think of that and nobody's telling you that. So that's why
And the bigger part is a lot of people bought it because of the dividend. That's with the dividend included. Yeah, like that. Yeah, I know. Like I used to own. So when I first, I have a whole bunch of stories. The very short version of it is when I first started, I didn't know what dividend yield was. So I literally backwards calculated dividend yield where I made a spreadsheet and I was like, if I put $100 into this, how many cents is it going to pay me back? And I remember AT&T was on there. I think it was like 7 cents for every $100 I put in. I was like, oh, okay. And then, so I called what I called the T-score because I'm creative. So each one had a T-score and I would just filter the Excel sheet and then write like where it ranked. And then I did like, okay, these are all the top T-scores in their respective categories. And I made like not bought a portfolio, but I made a portfolio. And I was like, okay, that's one to consider. Here's one to consider. And I kept doing that. And I remember I did have AT&T. I have an Excel sheet with like everything that I've ever bought, when I bought it, when I sold it, all the things. And I can go through and see my dividends that are paid out in my taxable account. And AT&T's in there. I used to have Sherwin-Williams. I used to have a bunch of different stocks. And then I settled on the ones I have now. But it's pretty wild just to think about. Like I saw somebody, I think it was on Facebook the other day, post about like a lot of people they don't understand, like you said earlier, that the dividend yield is a relation of the stock price. So the dividend yield can go up by increasing the dividend, but it also can go up by reducing the stock price. And sometimes the stock price just drops, and that's fine. Like it's, whatever, something happened in the market or the Fed rates or whatever it might be. But sometimes it's actually a problem with the business, and you need to be aware of that versus just saying, oh, here's, I got to add $5,000 because the dividend's, at 5% or whatever. Like you got to really be cautious of that. So,
it's not running away from a sale too, right? To again quote Warren Buffett, he says that occasionally the storm clouds come, the skies darken, and it rains gold.
Yeah.
And well, I shouldn't use gold. He doesn't like gold. That's a whole different discussion. But it rains money, and a lot of people will go out there with a thimble, and he's like, "No, you should go out there with bushel baskets to catch all the money that's falling." But a lot of us, dude, people run away from the sale. Like we've talked about that, or we haven't in general. We talked about people running away from sale when the market is down.
Yep.
People don't want to buy, and that's the best time to buy. And yeah, it's just that psychology, like you said, of understanding what you're getting into and buying that, buying not just buying the dividend yield. And it's easy to do. And like I said, what has two thumbs and bought AT&T for the dividend yield? This guy, you know?
Yeah, and also has a
terrible joke.
Sore
Awful.
shoulder from patting himself on the back for muting this guy.
Oh yeah, I'm still proud about it. I'll tell my wife and kids about.
Yeah, that was
later.
actually really good. That was really good. The fact that you were like, have you used Google Meet before?
Probably.
Oh, okay, I was going to say the fact that you've had a program you've never used before and you found the mute button while you were coughing is pretty impressive. But
yeah, you know, they're all kind of similar. They're all have some of the similar functions.
Yeah,
but
yeah.
Good old Google, ticker GOOGL.
Yeah, there you go. No
Alphabet.
Dividend. Okay, so next question for you. So dividend investing, you know, and I know, and everybody else, most other people know, is a very long game. So what are your short-term goals, maybe that you hope to accomplish like by the end of the year or within the next year? And then what are some of your long-term goals and how do you plan on accomplishing those?
Yeah, they're probably going to blur together. I mean, like I said, it's an infinite game. It's hard to learn that, like you said, just trying to be 1% better than you were yesterday, and knowing that really the only end is when I'm going out. But try and put that lightly. It's not a pleasant thought. And I say that because I just did a video that I'll be uploading today on funeral business stock. So a little bit, not heavy, but it's, you know, a few jokes in there.
In the spirit of Halloween.
Yeah. Well, I also had a family member pass away a couple weeks ago. We just had a funeral. So it kind of got me thinking, you know, the business aspect of it.
Sorry about
but
that.
Yeah, short and long term. Honestly, I was going to ask you, like your long term, are you, there's a thing that is buying low yield, high growth or high yield, low growth. And there was a study, I wish I knew the numbers, but if you buy the high yield, low growth, which is like an Altria, and you put that up against like a Starbucks, which has traditionally had a low yield, high growth, that in the first, 9-10 years, Ultra will outperform. But then the compounding kicks in from getting bigger and bigger dividend increases. And the latter half, like after year 10, 11, something like that, the low yield, high growth will overtake like the Altria. So that's something I'm also trying to work into my long-term goals, because honestly, I plan on doing this until I kick that bucket. But how are you thinking about that? Are you being in the camp of, because it's hard, right?
Yeah.
You see that Altria with the fat, 9% yield right now. I think they're yielding over 9% at this recording. And then you'll see something that looks like maybe a better business, and it's 1.39% yield, but they have a 15%, 5-year CAG or something, 20% 10-year CAG or something really high growth.
Yeah. I mean, so for me, I think the wife always complains about it, but I do a really good job of removing emotions from most situations. And that's really helped me with stock market. So what I'm able to do is when I do my filtering, to be fair, I haven't added any new stocks. The most recent new stock I added was Costco. And that's when I sold NVIDIA probably before I should have. Literally sold NVIDIA. Then 3 days later they had earnings and popped 24% because that's my luck. But anywho, I put it towards Costco. So,
don't beat yourself up for not knowing the future.
Yeah, yeah, that's true.
You can't trust me. I've been there, done that. We're not clairvoyant.
Yeah.
That's a fancy word for psychic. So you're not psychic. Don't worry about it.
Yeah.
Man. You didn't know the future.
Yeah. I knew you were going to say that.
See? Nice.
But yeah, no. So, I mean, my thing is as bad as this is to say, so one of the things is I don't even look at the dividend yield because like you said, it's not something I'm at the point for. Now, maybe when I get older to the point where I'm focusing on that, maybe the dividend growth rate will be the category that I remove from my filters and the dividend yield will go in there. Now I don't know. Like you said, I can't predict the future, but so when I'm filtering for my stocks, I look for, like I said, the 3 metrics I look at. The dividend yield is not one of them. And the other thing and I've gotten a lot of slack for this too, is the stock price isn't what I look at either. And the reason behind that is because if I'm buying businesses that I think are going to be more valuable in 22 years when I need them, I almost don't care what the stock price is today, because over the next 10 years, I'm expecting the stock price to go up, because that's obviously why I'm buying it. Not only go up, but go up higher than the S&P, which is, from my research, anywhere between like 180 and 200% over a long period of time is what you can total return expect from that. So like I'm expecting mine to go up at least 200%. So, double. Well, that would be what? Would that be triple?
I'm bad at math. Don't
Yeah, I
ask
don't know.
me.
Yeah, I know 100% would be double. I don't know what.
That's why I have a
whatever.
calculator.
Yeah, and all the numbers. But yeah, so I expect the stock to do that. So, and I've seen so many. Again, I'm a bigger presence on Facebook, but I've seen so many people in our group. They're typically a little older, but they tell me that they focus so much on stock price and having their stocks have to be at a certain price for buying. Let's just say it was Apple. They had $99.15 is what they wanted an Apple share at. It got down to $99.30, and they were so dead set on getting to that price that they mentioned, they never bought it. So for 15 cents, they missed out on thousands of percent gain from Apple for 15 cents per share. And I'm like, at the end of the day, you're not going to care whether your cost basis of Apple, providing you only bought it once, your cost basis of Apple was $99.15 or $99.30. It's not going to matter. Like, obviously, yes, it matters. You have a billion shares and like it costs, there's a couple $1,000s there, but like at the end for most people, it doesn't matter. So like, I don't know, the long-winded answer of your question is I don't focus on yield and I don't focus on stock price. I literally say, does this stock meet the metrics that I set? And then I look a little bit deeper into some of the other stuff. I'll do a little bit more research, but for the main part, that is my filters, because I can effectively narrow down list of hundreds or thousands of stocks down to 5% of that just by those three filters. And then it's like, okay, am I looking for something in the whatever? Am I looking for something in the consumer discretionary sector? Or am I looking for something in tech or whatever? And I can just filter for that. And then that does the rest of the work for me. Like when I filtered for Costco, literally I did I don't know, 15, 20-minute filter. I already knew a lot about Costco in general, knew it was a stock I wanted to own. I did my filters. So on there's a website called Portfolio Insights, and they have a free spreadsheet that they update every Friday called the Dividend Radar. So it's basically the champions, challengers, and contenders list. Super great. I was talking, I think it was Harris that I was telling this to. But it's a free.
Did you say Harriet?
Yeah, I literally said Harrius Elliott the first time I talked to him.
You've just given me ammunition. He's now Harriet.
I don't know if I cut that out.
Up,
but very end of his interview, listen to what I call. I'm pretty sure I messed it up there too. Anyway, I was talking to Harrius. And I was telling him, I was like, I was literally able to use that spreadsheet. I filtered for because obviously if it's the champion, challenger, contenders, they're all 5 years. So that first filter is already taken care of. I filtered the 1, 3, 5, and 10-year dividend growth rates for 10% or higher. It literally got, I think there's 787 stocks on that list. It went down to like 6. Just because it wasn't like, oh, I'm looking for a 10-year of 10%. It was, I'm looking for all of them above 10%. And okay, this one has a 1, but it doesn't have a 3 or it doesn't have a 5 or whatever. So just those simple filters. Then it was Costco, and I don't remember the other one. I saw Costco on there. I was like, I've been wanting to own Costco for a long time. Bought it. I bought it literally, I don't know, 4 or 5 months ago, and I'm already up like 11% on it. And it's had its peaks. When I first bought it, it never went down. Like it went up like 3 months in a row. It was just like, boom. Like I was like, what the heck? And then it started going down again, but I dollar cost average every day too. So I'm like, 10, 11, 12, $13 into all my stocks every day, because that's a way that I use to take the emotions out of it. I don't want to be like, oh, the stock market's down 5% today. Do I buy today, or do I see if it goes down tomorrow? Or does it go back up tomorrow? Do I wait for it to go back up or whatever? I was like, buy every day. I don't care what it is. Just buy every day. So
look at this guy. He's like a machine. You're like the Terminator, the T-1000, right?
Yeah,
Dude, you're emotionless and cold. It's funny. I'm going to piggyback off that. And Ben Graham is probably rolling in his grave at this discussion of not looking at stock price, because I think a lot of the older people, they get in this whole mindset of margin of safety, meaning that you want to buy a good business at as low of a price as possible, because even if you were wrong, the less you pay for it, the less money you're going to lose. And also consequently, on the flip side, the higher it goes, the more money you will make. But I actually put this into practice. I was trying to simplify it, and very well said, just like you said, is that if it's a good business and I think it's going to be a good business 10 years from now. Well, good businesses are always in demand. So a good business is going to be more valuable in 10 years than it is right now. So I pegged PepsiCo as one of those. And I bought one share of PepsiCo a week for 100 weeks to get to 100 shares so I could eventually start selling options on that. That's a whole nother story. But I did it. I bought one share of PepsiCo. I didn't care what the price was. One share a week, 100 weeks, did it. And it's come down now, and we could talk. I could give you my thought why I think it's come down. But at one point, I was up almost $4,000 on that position when it was at 196. Now we're back into the 150s. My cost basis is $150 a share and change. I do this adjusted cost basis, so I take all the dividends received, all the option income I've received, all the option premium, and then I add that to my adjusted share price. So it's more like 137. So right now it's like $126.50 or like $1.26.5 per share. So every time you get a dividend, your cost basis in my mind decreases by that amount. So yeah, and it's worked out. Now PepsiCo, their free cash flow has come down a little bit, and I'm not too happy with it because the free cash flow payout ratio is well over 100%. And free cash flow, for those of you not in the know, a business can pay a dividend out of their free cash flow. They can buy back stock. They can carry it as cash on the balance sheet, or they can that's it. 3, 4. I don't know how many I did there. Either way, there's like 3 or 4 things. I think I skipped one of them. It's still early, man.
Well, they can reinvest into the business too. I think that's
there you go. They can reinvest into the business. So those are the 4 things you can do. Thanks for the assist there on that layup. But yeah, so their free cash flow payout ratio is well over 100% right now, and I hope that's going to start coming back down. But I have my eye on it. So, like you said, man, I'm struggling because I'd like to own Costco outright. They are a fantastic business. Management is one thing. Like I've talked about Nexstar Media, they still have their founder, Perry Sook, running it. He founded the business in 1996. He's still the CEO. They have a lot of long tenured management. You know, that's one of the red flags is when you have CFOs or CEOs coming and going, it's like a revolving door every couple of years. No, their CFO just stepped down, not CFO, their COO, their chief operations officer, Tom Carter, just stepped down. He had been in the business since 2008 when it was trading at it was like 82 cents a share when he came in. And, you know, right now they're come down. They were in the 160s, 170s since 2008. But yeah, they have a lot of long tenured people. So I look at that. I look at, like you said, Costco. Jim Senegal is still the CEO of Costco. Like the dude is brilliant. Jim Senegal worked directly from PriceSmart, right? I think it was Sam Price. Mm-hmm. I think his name was Sal Price. Sal Price was the founder, like the predecessor to Costco. And dude, Jim Senegal ran their warehouse and distribution operations and learned from a master, and then went and started. I think Costco used to be called PriceSmart, right? Or Price Club, something like that. I don't even remember.
Yeah, something like they changed their name of it. And not to derail what you're saying, the thing that's wild is like Costco directly competes with Sam's Club, which is owned by Walmart. So like if you were to look at a 10-year chart of Costco versus Walmart, it's not close. Like Walmart is one of those stocks that everybody knows about. And it's a dividend king, or I think it's a king. I know it's an aristocrat. Yeah. So
wait, they may be. I think they're at like 48 or 49.
Yeah, I was going to say, I know they're about to. Them and Target are always they're right there.
Oh, don't you worry. When Walmart becomes a dividend king, there'll probably be a slew of YouTube videos about the newest dividend king.
Yeah.
So.
Yeah. So
I'll probably be one of those.
And it's one of those things like the everybody's like, oh, it's just like, you know, the bulk buying that's this. I'm like, okay, well then why doesn't Walmart get the same bump that Costco does? It's ran different. The CEO of Walmart, you know, is long past. He's, you know, Walmart's forever old. So and like what you're saying about the CEOs still being there and being there for such a long time, when you are the CEO and the creator of a company or something like that, you care about a lot more than some guy or girl that just comes in and runs your business. So like you want to make these decisions with integrity and like actually think through, because it's your business, it's your baby. So it's one of those things.
Yeah, and that's something that I also look for is the management team. So that's you know, we can build on. That's been an evolution of mine, is looking at management. Like, who are the people that are running this business? It's important because if they decide that they want to buy Warner Brothers Discovery, they want to buy a movie studio, and they're in the telephone business, it's like that could really, really destroy future shareholder return and value, which it did. So yeah, I love looking at especially companies that, they have a lot of soul in the business. They have their heart still in the business, and a lot of their fortune is tied to the business too. So that's why, like for me, Next Star Media Group, I talk about them a lot. Like it checks so many boxes, and if I'm wrong about them, then it's going to be a really humbling experience because so many things I'm like damn sure about will turn out to be wrong. So it's always learning. I don't remember. Go to the next question. There was something else I was going to say that was it escaped. Oh, real quick, PepsiCo. I've teased it twice now. I don't want to be a tease. I think that the utilities, the REITs, a lot of the consumer packaged goods companies are coming down in price because if you look at the 10-year treasury, the yield on the 10-year treasury is that has gone up almost at the exact same time. The consumer packaged goods like Coke and Pepsi and Keurig Dr. Pepper and Hershey have started to come down because people use those as bond proxies. And I know you can't look at a stock as a bond because they're different, but they do. When bonds were paying like 0.30%, people were going to the stock market for higher yield. And because people, some are really risk averse, they don't want to risk a lot of their money, they would buy PepsiCo and Coke and REITs because of real estate, and the utility companies that are kind of like a monopoly. But as those yields have gone up, stocks compete with bonds. That's why it's important to, kind of pay attention to what the bond market is doing, because as the bonds go up and become more attractive, it's sucking money out of the stock market. So that's why I think we've seen the big fall. But I think it's a great time to buy REITs because as soon as they start cutting the interest rates, I think investors are going to get nervous and think, okay, we're going to have to go back and look for higher yield in the market. So I think we're going to see money just like the pendulum, just kind of flood back in. So I don't know. Those are my thoughts on why I think PepsiCo and a lot have been beaten down. So it could be a great buying opportunity for long-term investors. And if only Costco would just come down, I may have to follow your lead, Troy, and just get in. But I will say I'm at least happy that have exposure inside of mutual funds. So
Yeah.
I still have money in it, just not as much as I'd like.
Yeah. And that's the one of the really big things of why I do the things the way I do is just like, I don't want to have, like, you have the FOMO, the fear of missing out, but then that can go both ways. That can be the fear of missing out when like you don't own something that everybody else does, but it's also like you're like Costco. So you'll notice that neither one of us ever brought up PE yet, because I don't think PE is that valuable. One, PE is very different from not only sector to sector, but not then industry to industry and even stock specific. For example, Costco, tying all this in, they always are very high for their sector, very high for their industry, and very high when you're talking about their competition. But their results support them always trading at a premium. So like when I bought Costco, didn't look at the price. I think I bought it at like $4.96 or $4.97 a share. And now it's like $5.40, $5.60, something like that. To be fair, I don't really even look at the stock price when I'm buying it again. Like when I go out there and I'm just like, okay, today's Monday, I'm going to buy my stocks. I just look, I'm like, okay, it's down 0.8% today. Cool. I'm getting it for 0.8% cheaper than I would have got it for. That's all I look at. Like I can't remember stock prices.
Oh, dude, let me real quick, but on that, that's a great point because a lot of us fear buying stocks at all-time highs.
Yep.
But if a stock is at an all-time high, don't you think that means that they're doing something right?
Yeah.
That this is a good company that people are wanting to invest in and buy. So they don't have to stop at this, mythical all-time high. They can keep going up. And I have done that. I've sold things at the past when we're just talking about throwing mistakes out here. I've sold stocks at all-time high only to watch them just keep climbing higher and higher and higher. And it's like Peter Lynch said, that's the equivalent of cutting the flowers and watering the weeds. It's like, why don't we not do that?
Yeah.
So,
yeah.
right. Like it's crazy for me to think. I'm like, Troy, you're buying Costco. Like you're not looking at the price.
Yeah. I mean, at the, like, I don't know. I just like, to me, now my cost basis now is, I think, up to like 504 or something. So my cost basis keeps going up, and I talk about this in my monthly recap and stuff like that. But like at the end of the day, would I rather own, I don't know how many shares I bought when I first started, like 3 shares of Costco at $4.99, or would I rather own 15 shares at $5.04? Like to me, like that's the difference. And that's what people are doing. They're waiting for this perfect price to load up. But what if that perfect price never comes? Yeah. Like, and today's 52-week high could be, like the 10-year low later. Like, and that's what it is. So like everybody's freaking out. Oh, Troy bought Costco at 540 today. That's cool. But like in 10 years, like what's to say Costco is not worth 1,500? And now you're like, oh, Troy bought Costco at 540. I'm like, yeah, I bought it at 540. So I don't know. But so this is another good segue. So speaking of that, do you have any biggest selling regrets? And then do you have any biggest buying brags? Like something that you identified and you're just like, man, I killed it with that one, or something that you're like, man, I sold it and I shouldn't have.
Yeah, it probably, and it's not a dividend stock. It would both be Tesla back around circa 2018. And this is one where I learned the hard way that nobody knows the future. And while it's only 2 little shares, I bought Tesla at about right around $200 a share, pre-split, before they ran up, everything. And it's like I got it right, but it ended up being wrong. And the people I listened to got it right, but ended up being wrong. So, oh my God, Troy. I liked Tesla. I saw this, they're starting to be everywhere. Very interesting. I didn't obviously dig into the company, but a couple different financial podcasts I listened to, people in the know, like Wall Street veterans, a couple of them had been 20 years in the market. They knew their stuff. And both were saying the same thing. They didn't even know. Separate podcast. We're saying that there's so much debt. It's just a matter of time. Tesla's burning so much cash that they're going to end up in bankruptcy. And the winners are going to be whoever buys Tesla's assets out of bankruptcy and they go to a well-run company. That's who the winner is going to be. So you got to get out. And I think it was like 220. I think it was 218, 220. I wrote it from like 200 to 218 or 220. I made like $40. I got out. I was so happy. I was like, sweet. I'm like, I'm not going to be one of those suckers. But what we didn't know was going to happen is that I think it's a cult. And apparently when you're dealing with a cult, Elon Musk would just dump more shares on the market. They would just dilute the hell out of shareholders and everybody bought it up and held. And it was the craziest thing because they were just able to bring in more money and eventually right the ship. And this is something that's super unique that we really haven't seen before, because when a company is burning cash and they start diluting, meaning they're just issuing more shares for people to buy, well, it means that there's more shares to spread the earnings out over. So it means there's less earnings per share is what it's going to be. And I remember looking and thinking like, oh yeah, these guys are right. Like this company is going to go bankrupt. And it didn't happen. They just skyrocketed. I literally sold out and walked away on the launching pad. And I was like, suckers, like sweet. And then the splits happened, not reverse splits, but the splits happened. And it's just, I think I tallied it up and I probably left like, if I would have just held those 2 shares, it would have been a gain of something like $6,000 or $5,000, something just stupid, like whatever it was ridiculous. And it just goes to show you, dude. What's that?
Do you think that was healthy for you to do that research?
No, probably not. It was more, maybe I'm a little bit masochistic. I don't know, glutton for punishment. But so it's weird because it's not a dividend stock. Yeah. But I got in early. My wife even said, she knows nothing. She's like, oh, why are you selling it? She's like, I think it's a cool company. And I was like, but the cash, they're burning the cash. Like, you don't understand. And now she'll even say, I told you not to sell those Tesla shares,
Does she have her own Tesla shares still?
No, she doesn't have an investing account, which we've talked about. I don't know why. We should open up a Roth for her. So yeah, again, like that's kind of been the theme. Nobody knows the future. Yeah. Like the one dude I listened to, I don't want to throw his name out there. I'll throw it out. Frank Curzio. He's been in the market for 20 plus years at that point. Dude knows his stuff. And I was like, he knows, like Frank knows, but I'm not throwing shade. I'm just saying he was convinced. He wasn't like trying to lie about something. He's like, I'm looking at the numbers. They're going bankrupt. Like, you better get out,
Does he talk about them now or no?
I kind of stopped listening to his show. I don't know. I kind of lost touch a little bit, but yeah, he's one of the ones he was wrong about. And, but man, Troy, it's again, nobody knows what's going to happen, but I do know what's going to happen, how to get financially free. I don't know if you want to segue into that. I may have jumped the gun, but we talked earlier. I was going to share the 3 simple steps I've used to right my ship and right our family finances and get well on the way to, I say that now, it's funny because before the market started nosediving, and this is what, yeah, sorry, I struggle with brevity. Believe me,
No,
I really
you're
do
me
struggle
too.
with,
Me
with,
too. Me too.
with brevity. Anyway, I'll let you ask a question. Why don't we just cut it off there?
Yeah,
Cause
no, no.
I'll ramble
I
forever.
want to. I do like that idea that me and you were talking about in the beginning of this. I want to save that for the end because I think it's going to be one of the best
Okay,
things we talk
good,
about.
good.
Okay, so next question. You're going to like this one. So, what dividend milestones or achievements have you accomplished or are you close to achieving? And then what role do those play in keeping you motivated?
So I have a bunch of portfolios, and it gets a little, the water gets a little muddied because on the channel we have a taxable account, and these are all things I started after I started the channel. We have a taxable account. We have a self-directed IRA, which I took 30,000 from the 401k, and it was an equivalent rollover. So I had to pay like $100 in processing fees, but I rolled that 30k over to the self-directed IRA in like March or April of 2020, and that account is, I call it the locked in account, meaning that I have not put one penny more into it. And I think it's up to like 40, I don't know, 43K, something like that. So it's gained like 13 grand since March of 2020. Granted, it's had a boost. I got lucky buying at the bottom of the pandemic sell off. I bought a lot of the stuff in there, but um, so we share that, and we share the Roth. So those three combined, I think, are pushing like a little over 6K in annual dividend income, Patty, projected annual dividend income. So I think 10K is going to be pretty cool to hit that. But I don't even know what my 401k does. I'm not even thinking
Yeah.
about that. That's where the bulk of our retirement money is. By the way, I think I'm up to like 21%, 21% of every paycheck goes into that to get that maxed out. So, well, what was the question? Oh, the
Uh,
biggest
yeah, milestones and achievements and like how do those
yeah.
keep
So
you
I guess
motivated?
I honestly like $1,000 in annual dividend income was pretty cool, but honestly, there's no end goal. It's just to focus on the dividend income, and this is what helps. Even though the portfolio value has taken a big hit, because I'm not intending to sell any of that anytime soon. As long as I see that dividend income the same and growing, then that is motivation that I'm doing something right, because it's trying to focus on the dividend income. And, that could be to a fault. We don't ever want to paint ourselves in a box. And yeah, I don't know. That's something I struggle with, thinking like, should I say I'm a dividend investor? Like, isn't that ignoring a whole bunch of other things? But I don't know. That's what the 401k is for, I guess. So that's motivation, is just seeing that dividend income keep growing, and keeping on with that.
Yeah, I think that is one of the biggest things that I always focused on it, but hearing these interviews, it's really made me realize that a lot of other people enjoy it as well as that Patty. Like I think that's the number to focus on, but you want to be careful how to build the Patty because you
Yeah.
can overwhelmingly say, "Oh, I just want to get this as big as I can as fast as I can." And that's where you start chasing the yields and not really caring about your actual portfolio value. Your Patty could keep going up, but then all it takes is one dividend cut and then you're, right back to where you were 3 years ago, and then that's demoralizing. So, the Patty is just something. It's cool because every day, like literally, I buy every day. Every day I get to see it. Like I have an app on my phone called the Dividend Tracker, or Div
Yeah.
Tracker is what it's called. And literally, I go in there. So I buy it on Fidelity. I update my spreadsheet, and then I pull it up on my phone, and I literally just say, okay, now I have 24.995 shares of Apple at this cost or whatever. And then when I go back to the main screen, I get to watch that number. Like it does like the little rolling thing, and it just rolls
Yeah.
up to like the next $4 or $5, and I'm like, cool. Like there's four or five
Nice.
more dollars. So and it's just like little motivation like that. Like I said, I don't look at the stock price anytime I buy. I'm just like, I want more shares of this 10 years from now than I have today. So I'm going to buy it. Like the only way I do that's buying more shares. So I think it's going to be worth more in 10 years. And, I could be wrong, and I could have had 100% profit on a stock and I only have a 60% profit. But the difference is there's also a third option of having a 0% profit because I never bought the stock. So that's the part that nobody ever focuses on. It's like, okay, everything could always be better, but it could also be worse.
Yeah.
Like,
Let's just be directionally accurate. We'll
yeah,
call that.
exactly. Like how many times, you're on your way to work or on your way to the grocery store or whatever, and you get a flat tire. That sucks. but it's one flat tire, you have a spare. You could have two flat tires, and that sucks because you don't have two spares. So then you're like, it could always be worse. So I don't know. I don't know if that is tied to anything that I just asked you, but okay. So here's the next question for you. I think this is going to be a good one. When or how will you know when enough is enough? I know your dividend journey is forever lasting, but like when you want to get to the point of financial independence, maybe retire early and stuff like that, like when is it okay to say, okay, we're good here? Like 80 grand, 100 grand?
Yeah, I think, that's tough to say. And you can hear me struggling with that, but it's almost like there's Manisha Thacker, I think, is a book I've been meaning to read. She wrote a book called The Cult of Never Enough. And we can all get sucked into this cult, meaning that we're just trying to get as much as possible, as quickly as possible, and just not focusing on the things that are really important in life. So I think you're right. You should reverse engineer it. And that's something I have yet to do, is to exactly pinpoint what is enough. And then because how do you know when to stop?
Mhm.
Like how do you know? That's when I think you get people that have a $50 billion net worth and they're like, no, I need 100 billion. It's
Yeah,
like,
yeah.
okay, but you have enough money that it would take you spending like 150 grand a day for 200 years to run out of money if you didn't have another penny come in. Like, I think you have enough. You
Yeah.
would get exhausted trying to spend all that money every day. But that's a great question, man. I'm just going to say, I don't know.
Yeah.
I don't know exactly what enough is, but I do know that I'm shifting to try to do things that make me happy while at the same time just keeping and just building up that patty as much as I can.
Yeah. I mean, that's kind of my answer too. Cause like the thing that's even worse, I mean, it's a good worse, is dividend investing. The compounding is real. So like, and this is the thing I'm going to struggle with. I always have like weird numbers to give, but like, let's just say in year 22, when I need the money, I'm making $88,000 a year in passive income just for funsies. But
Yep.
then if I wait one more year, I didn't hit my goal. I'm 51. I had 23 years, but say I'm making $100,000. Like, is it worth $12,000 just to miss my goal by 1 year? Like, I'd say yeah. But then the next year I'm going to fall into the same thing, because then it could be another $15,000 just because compounding's so aggressive at that point. So I know I'm going to struggle with it. I've gotten a couple really, really good answers on that question. And then I've gotten a couple answers exactly like me and you were saying, where just like, I don't know, like what there's a quote out there. It says the bulls make money, the bears make money, but the pigs get slaughtered. Like,
Yeah.
I don't want to be the pig, but I see myself being the pig. Like, I just don't know when it's going to be like, okay, now I can take a step back and say, this is good. Like, we're okay here. So yeah, I don't know. I don't know the answer to that. There's no wrong
We'll
answer.
see. You're right. There is no wrong answer, but I don't know. I was going to say something else. I forgot. I've forgotten. Just
There we
getting
go.
older.
Okay, so do you have specific criteria you use when you select your dividend stocks, and then what is that?
Oh, dude, could go on forever here. Yeah, I'll try to abbreviate it as
Where's
quickly
your
as
Cliff Note?
possible.
Does Cliff Notes still exist?
I have no idea.
It was a
I
thing
was
when
too
I was in
poor.
high
I couldn't
school.
even
So
afford them.
what's
Yeah.
your
No,
Cliff Notes version?
oh man. Just to understand the business, that's criteria. Understand the business, look at the management team. Uh, and if I can understand why they're going to still have a competitive advantage in 10 years or longer, then that's probably a good thing to invest in. And of course, like, I need to look at profitability metrics, like your cash flow, your earnings per share. I'm real big on cash. I love free cash flow, because where the cash is at, that's really hard to financially engineer.
Mm-hmm.
It's really hard for the accountants to manipulate the free cash flow. So you just want to see that growing. I mean, a lot of people can focus on revenue, and I love when businesses just focus on the revenue. It doesn't matter if you're selling dollars for dimes. No, yeah. If you're selling, I thought I had it backwards. If you're selling dollars for dimes, dude, you'd have a line around the block, but you're losing crazy money. So you're not profitable if you're doing that.
Yeah.
So it's looking at the profitability metrics. There's a bunch of them, but the Cliff Note version is free cash flow. And then obviously, can they sustain the dividend as well? And just trying to focus on more of being a business owner. So that's the Cliff Note version. And dude, we could literally talk for 3 hours. I mean, it's quite a bit. getting into the weeds and the nuances of it. But that's it. Just good management, a good business that I understand, and do they have good cash flow, or also profitability metrics after? What are they doing with those dollars after they come into the business?
Yeah. Well, and that's where I got the metrics that I created, which I really, obviously I like them. I'm impartial to them because I made them, but the thing I like the most about those is how much they encompass about some of the things that other people research, and where I like, to me, you're not going to be able to continue to pay a dividend, quickly grow that dividend, and outperform the market unless you have good management, unless you have good fundamentals of your cash, unless you're spending your cash wisely. So it's kind of one of those things. I sat back and asked myself, what questions can I ask myself that I understand that encompass a lot of things that I might not understand? So it could be one of those things where, like, maybe this is a section that you can take going forward in your own investing journey, where it's like, how can you help yourself simplify your investing strategy to where you are only looking at the Cliff Note version and you don't have to dive into so many things, because maybe that makes less stress and then you have more time for the family or YouTube or whatever it might be. So
you almost reminded me there of Charlie Munger. He has a famous saying, invert, always invert, meaning that you're supposed to start out looking at all the negative things that could tank the business, all the reasons why I should not invest in this. And then you have to reconcile those to see, is this really enough of a reason that I shouldn't invest? Yeah. So a lot of us like to do the opposite. And I've been guilty a million times of that, is looking at all the good reasons I should invest in this business. So take it from somebody that's far superior in their knowledge and investing experience. That's probably what we should be doing, is starting out with the negatives and then trying to see if those are enough to bring the business down anytime soon.
Yeah, I like that. I like Charlie Munger is he's the quote one. I mean, Warren Buffett gives all like the mind-blowing stuff. Charlie Munger just calls people idiots all the, like, he's funny. I love listening to Charlie Munger.
He's almost out the door.
What's he say? 99. The crypto crapo, that's his thing.
Oh, I don't know what he is. He's not fond of crypto. And dude, I love it. These two stodgy old guys. I even thought they were wrong when I saw Bitcoin going to the moon.
Yeah.
And they were like, it's garbage, don't buy it. I was like, they might be wrong on this one. Well, I guess depending on where you bought it. If you bought Bitcoin at 60K, they were right. But if you bought Bitcoin at $5, they were wrong. So.
Well, I mean, at the end of the day, I mean, they could be temporarily right and long-term wrong. I mean, in 10 years, Bitcoin could be worth $1 billion and they were wrong. Yeah. So they're right for now, maybe. Okay. So I think we have like 2 more questions left. So
sweet.
First question, or this next question, is how important to you is staying diversified? And then what rules do you use to help you stay diversified? Like, do you care about like certain percentages in each stock or each sector? Or how do you do that?
I did, but now I'm all about the business.
Okay.
I'm going to diversify through good businesses. And, again, I'll go back to Warren. Like he said, if you should put your money into your like 5-10 best ideas. And out of those, like if you have your 1 or 2 or 3 best ideas, like why would you put money into number 10 or 12 or 15? Wouldn't you just keep putting it into number 1 or number 2? So, I'm not to that extreme yet, obviously. It's just absurd to even think I could compare myself to somebody like that. But which, they have a lot of investments. They have more than 10 investments. So, take that for what it's worth. But yeah, I'm not really focused. I used to do that. I'd be like, okay, I need this much in utilities, this much in real estate, this much in consumer and discretionary. Now I'm just like, nah, you know what? I'm just going to find those good businesses, the businesses that I think have a really, really long time horizon and runway. And right, it's a battle. Every business is going to go out of business or be absorbed into another business. It's just the way it is. Some may take hundreds of years, but it's just trying to find the ones that are going to be around for quite some time as of right now. But just that's it, man. Just diversifying into good businesses and not really trying to focus too much on the sector diversification or, I guess you probably shouldn't have, I don't know. Well, Manish Pabrai, he'll do that. The Indian investor, I love him. He'll put like 60% of the portfolio into one stock. And I'm like, ugh.
Well, doesn't Warren Buffett have like 51% into Apple or something like that?
So I think they say it's like 50, but it's not, because if you look at Berkshire as a whole, that's the marketable securities. Like everyone loves to focus on them investing into, Apple and Amazon they even have, and all those stocks that they buy, Marsh and McLennan and whatnot. But that's just a small part. Like they have all the wholly owned businesses too, like Burlington Northern, like Dairy Queen, Oriental Trading is one that they have. I mean, they have, I'd probably say a good, I don't even know, 50, 60 businesses that they like See's Candy
Yeah.
that they fully own. So if you compare it to, lumping in with all those, like their insurance businesses like Geico and General Re, it's going to be a much smaller. So it's 51 or 50%, whatever, of the marketable securities. So, yeah, but it's one that it's funny. Like he always said he didn't understand it. And then he looked at it as like, oh no, this is like, he didn't like investing in technology. That's why they avoided Amazon and they avoided Microsoft and the like of that. But yeah, he said this is just a good people can't live without. It's like a Hershey bar. People need their iPhone. So he doesn't understand the technology, but he understands the human behavior associated with the iPhone. And I guess he thinks it has that durable competitive advantage.
What kind of phone does Warren Buffett have?
I don't know if he even has a phone. Who knows?
He has
I know
the
he likes to
Nokia
play
brick.
bridge. Yeah, he might. He might. I know he likes. Yeah, he's all about bridge and being old school and driving old cars and whatnot. So not old like classic cars, just 15-year-old whatever he drives.
Yeah, I remember watching the I think it was on Netflix, the documentary with Warren Buffett, where his wife still puts like a certain amount of cash in his cup holder every day when he goes to McDonald's, and like based on he knows how much, well, at least he used to know how much everything cost before inflation, but he used to know, okay, she put $2.11 in there. That means I can get a small black coffee and this. And I was like, dude, you have enough to buy that McDonald's every time you go there, and you're worried about like what you could get off the dollar menu, but. They don't even call it what is it now? Like the value menu? Is that what they call it?
I don't know. Even though I own McDonald's and I'd like to buy more, hey, there you go. This is one. My cost basis is like I don't know, 160, 170, or no, 180, 190s. I was buying it at the low end in the 150s, I think, but during COVID. But yeah, I don't eat McDonald's. I don't eat McDonald's. I don't go to Starbucks. As I say, I don't like to get high on my own supply. But I do own the businesses.
Yeah.
My kids sometimes do go to Starbucks, but anyway.
Yeah. I mean, I don't own McDonald's, but I don't go to Starbucks. I don't drink coffee at all. But literally every time I go to the store on Sunday, I come home and I have to go in the far lane to get around the right lane is blocked off by people going into Starbucks. It's always busy every time I drive by. Like
beautiful thing.
I'll drive by it at 8 a.m. I'll drive by it at 8 p.m. And it's always, I'm like, do you guys not sleep? How are you drinking coffee at 8 p.m.? Like I would be awake for the rest of my life if I did that. But
yeah, I don't drink coffee either.
Yeah.
Matcha green tea I got here.
Yeah.
Matcha green tea.
Okay. So that was, I agree with you. There's been a couple people I've asked that question that's really opened my mind for like how I'm going to gear my portfolio in 2024. Stay tuned for that. Is kind of like the diversification strategy of like buying your winners. It doesn't really matter how much in one sector something is. You're buying good stocks. So you want 100. That's how your diversification is. You want 100% of your money in good stocks and 0% in bad stocks. Everything else is just whatever.
Dude, that's mental. If I'm like, my highest conviction right now is Nexstar Media, but I have a high percentage in this sector. I'm like, so I'm going to go have to look for a utility to buy. Mm-hmm. And then just like, okay, I guess I'll go with this. That's crazy. Yeah. Like
I'm the same way. I don't have any in my taxable account. I don't have any real estate and I don't have any communication services because I don't like the disadvantages for real estate in a taxable account. And for communication services, I don't have anything I like. Why would I force myself to buy that when I can buy Apple or Microsoft or Visa or Costco or something like that?
Exactly. So you're building your core, and I guess that's how we could wrap that up. Is say there's a thought out there that it's core and explore. Meaning you have your core portfolio that is whether it's ETFs or whatever your highest conviction is in, you're most certain about, and then you have a small percentage for exploratory positions that may or may not be as good.
Mm-hmm. Yeah, I think next year I'm going to set it up as like my active positions and my dormant positions because I've been burnt by selling. So my thing, and this is an interview I had a while ago with David Maloney. If you haven't heard it yet, very, very good interview. Mm-hmm. And him and I were talking. He said that his biggest selling regret was selling. He goes, in most cases, he was like, I would have just been better off to hold it and not add any more money. Because he goes, he's sold too many winners and hasn't sold enough of his losers. So he's like, I just need to hold. And that's kind of
Brilliant.
one of the questions I wanted to get to you. This is off topic, or off script. When you're with your AT&T, have you ever thought about the cost benefit analysis of like holding on to AT&T for a price it may never get to versus selling it and taking your lump on the chin and actually putting that
Oh,
money in a business that you would like better?
Oh, 100%, man. 100%. Yeah, it's cost opportunity,
Yeah.
right? Of holding it. Like I could have it in something else, but I look at that be whatever I'm down like 22% or something. I'm like, God, I'm like, it'll come up. Like I'm sure by the end of the year it'll come up. And actually, this is something I really need to start doing is I'm doing this because starting some kind of thing on my phone. I'm going to create a spreadsheet because I remember, and it's getting fuzzy, and this is why we should do this. It's a way to grade yourself is write down, say, I'm doing this because. So I held AT&T because at the beginning of the year, when they really got hit hard, their cash flow came in a lot lower than they projected. But as Pascal DeRoche, their CFO, had said, he's like, look, this is, yeah, it wasn't as well, but if you look at the last couple years, as the year goes on, our free cash flow increases. So at the end of the year, we're going to have a lot of cash coming in. So this is going to more than make up for it. So I said, okay, I'm going to hold because I think the market will see, oh, look, they got more cash coming in. So their share price is going to be higher. Well, here we are in mid-October and it's still around the same spot that it has been, and things haven't shook out the way that he said it was going to. So that's kind of a good thing because now the next time I hear that, like you're supposed to be able to grade yourself and say like, oh, the last time I did this because, so do I want to repeat the same behavior? Like as humans, right? As human beings, we're pattern seeking animals. So trying to understand what we're doing in the past or why we did something can help us prevent or mitigate future, repetition of things that we did or shouldn't have done. So that's something I got to work on, but I get so busy with everything and I forget. So we need to work on that. But yeah, so I should, in all honesty, I should Monday morning sell all my AT&T because I'm not convicted in the business. I don't want to be in the business anymore, but I'm so damn stubborn for taking that loss. And this is one of my problems, but
Well, now
yes, Troy.
like you got to think about it. So like if you would have, I don't know when you identified that you wanted to actually sell AT&T. Just say it was 6 months ago. If you would
About a
have,
year ago.
yeah. So if you would have cut your losses then, and say it was even more, like say it was actually 30%. Now it's came up a little or less down a little bit. Like if you would have just took that loss then, not only did you lose the money that you're still going to end up losing, but you lost the opportunity of buying a better business, whether it's Costco, getting into Costco like you said you wanted. And I bought Costco in, I don't know what it was, June, and I'm already up 11%. So if you would have bought it in
Yeah.
January, you would have been who knows how much. But like it's one of those things. So you're delaying the inevitable. Like, at the end of the day, you called out the chart earlier about AT&T, T-Mobile, and Verizon. AT&T's negative 2% or 10%, no, 2% over the last 10 years.
Negative 2%.
Yeah. So like, what makes you think that the next year is going to be any different?
Well, if you listen to management, they're saying they're done building out the 5G infrastructure in the
Yeah.
next couple of years is when, so they
And
did
then
all the
6G will
capital
come out.
spending. And right. And
Yeah.
now they said the next two, I'm not kidding you. This is what they said on the earnings call. So in 24, it's going to start, and then 25 and into 26 is when they're really going to start raking in all the cash from all the infrastructure that they've spent the last few years building out. But dude, you reminded me of that saying that says you don't have to make your money back the same way you lost it. And I'm just hard-headed, and I'm apparently not learning that lesson yet.
Yeah. Well, I mean, like I said in the beginning before, like when I was telling you like what this conversation's goal is, the goal is to, if you can make this mistake now and you're down 20% and that's 2, 3, 4, however much thousands, that's the price of your mistake. As long as you learn from that mistake and don't have to make it again, you don't have to make a $10,000 mistake later on. So
tuition of the market.
Yeah, there you go. Okay. So here we go. One of our last questions. Are
Yes.
there any dividend myths or misconceptions that you hear? You're really plugged into Twitter and obviously YouTube. Have there been any misconceptions or myths that you hear that you really just want to debunk and tell people like, hey, this is just flat out not true?
I don't know. I'm sure there's a lot. I mean, none really just pop into my mind, but one is like people thinking they can capture the dividend, meaning as soon as you get paid the dividend, then you can sell. So it would work out the ex dividend date. So on the ex dividend date, that's the day it locks in that you're guaranteed that dividend and you can sell on that day. But uh, the share price drops the exact amount that the dividend is going to be, because the business has to pay that money out to the shareholders. So dividends aren't free, but that's why we want good businesses, because they're going to make that money back and they're going to earn more. So I guess the one that people think that dividends are free, that they can just get paid the dividend and on the ex-dividend date they can sell. Plus, you're paying short-term capital gains on that,
Yep.
so we don't want to do that.
Yeah, and any money you made in your dividend, you're probably giving back in taxes. So
yeah, I mean, you might come ahead. It's not as easy as it is, but yeah. And then I think we've covered it. Just the misconceptions of buying high yield chasing. That's, I don't know if that's a myth, is more of a misconception that people think they can do.
yeah. Yeah, I agree. Yeah, another one I always hear is like dividend investing is like an old person's game. You only get into that. Like they seem to think that, if you're a dividend investor, you need the income, but you're sacrificing the growth. And I don't understand how you can only have one or the other. Like, to me, I do dividend growth investing. So not only do I want my companies, but I also want my dividends to grow. So that's another thing. You don't have to wait until you're 65 to get into dividends. You can start the sooner the better. Because like we were talking about earlier with the how do we know when enough is enough, compounding in dividends is real. Like when you start seeing those projection charts and stuff of like 20, 30 years from now, you're like, how does it go up so much? That's incredible.
Right.
Okay, so here we go. We're going to get to this, and then we're going to get to your finisher that everybody needs to stay for. So so somebody's watching this channel today, or they watch your channel. They decided that they're going to start investing, and they decided that they're going to do it in dividend stocks. What would be your tips and tricks for them from that point going forward? So it can't be getting started and it can't be do dividends, because both of those are already on the table.
So just if they're already a dividend investor?
You can say if they're already a dividend investor, they already decided that they're going, like Monday morning market opens, they're going to invest and they're going to do dividends. So like what else? What would be
Stop focusing on yield.
Yep.
Look at the business. Like just that's one thing I learned the hard way, is that those high yields, because like we said, dude, passive income is a hell of a drug and you're going to look for a bigger hit. Trust me. I know. I'm still doing it. I'm still working through it. But my dividend demons, I guess, still working through those, is that just focus on the business paying the dividend. Like the dividend should be one of the honestly last things you look at, because dude, the dividend can be cut at any time. There's no agreement. There's nothing written in stone. That dividend can go away tomorrow. I don't care if they've been paying it for 100 years, growing it for 100 years. The next day they can say like, yeah, we can't pay that anymore. It's gone. Like it's not a relative that's going to give you a gift every year and you're upset about it. Like, so that's the thing. Stop focusing on the dividend yield, even though that's what we do. You want to understand the business and understand the business behind the dividend and make sure that they're going to be able to keep paying that.
Yeah, I agree with that. I liked what you said earlier about like you're buying a piece of the business. A lot of people are buying the dividends and not the business, but you need to buy the dividends buy the business that pays the dividends, not the other way around. So
and I've done the opposite, man.
Yeah, I mean,
it's worked out sometimes.
Yeah,
sometimes not so much. Yeah. Like hello AT&T.
Yeah.
You sum a gum, you.
That gum at AT&T. Okay, so you mentioned earlier that you wanted to speak about your 3 tips to financial independence. So what would you mind sharing those with people and letting them in on your secrets?
I love this. This is like going to just break it. And you could hopefully put a timestamp on this. I don't know. This is going to just almost every financial book you'll ever read. This is boiled down to its essence, is you have to underspend your income. So you have to spend less than you're bringing in. Stay out of credit card debt. Stay out of high interest consumer credit card debt. If you're paying 18, 20%, whatever it is now on a credit card, it's going to be really hard to get ahead in life paying 20% interest on your money. And the better thing that I like to look at is to be on the other side, is to, how about start getting interest, like getting 5%, 4% interest, whatever it is. You'll get much further ahead receiving interest instead of paying that interest. And then, after you've paid your bills, that's part of the underspending your income, is living as cheaply as you can while still maintaining some happiness, is to invest the remainder into predictable as possible growing businesses and cash flow, and then just repeating that process. So that's it, man. 3 steps: underspend your income, stay out of high interest credit card debt, and invest the rest. Like that's it. It's that simple. So it might take a lifetime to learn, but that's it, man. That's the key. Those
I
are the keys to financial freedom.
Yeah, I like what you said. The first step being very important because like when I did my simple path to wealth or whatever the video is called, I always start that. A lot of people always when they are trying to look at their budget and they're trying to review how to make more money, that's always the first question is how can I make more money? To me, the more important question is how can you spend less money? So the wife and I are just now combining our finances. I've been talking about this for months because we're still doing it. The first step was I wrote out everything I spend when it comes out, how much I spend. She did the same thing. And we both highlighted things that we could either go without, we could cancel, or things that we think we could reduce. And that was the first step because that's the easier thing to do than go to your boss and say, hey, I want more money or get a side job or whatever. Like you might have the time, not have the time, or you might not have the relationship with your boss or your work ethic might not support getting more money or whatever it might be. So the easiest thing to do is spend less. And then you can also work on making more. And that goes back to what you're saying. Like you need to spend less than you make because I know a lot of people from personal experience who do the opposite of that. And then they're they think life's against them or whatever. And I'm just like, no, like your standard of living is like you're making 100,000, but you're making 50. Like you have to that lifestyle creep is real. Like you get a raise at your job. You're like, oh, I can afford an extra $100 on my car payment. No, you can't. You can't do that.
Well, your greatest financial asset is your own productivity to earn money, your own capacity for the money. I mucked it up. How does it go? You've heard that saying, right?
Well, I mean,
Your greatest financial asset is your productive capacity to earn money. Like that's an AKA investing in yourself, like your brain. What you put in your brain can come back to you in dollars. That's the very most important thing. And just to tell, like what we've done is we cut out all the things that didn't bring us happiness, like going to Starbucks or going out to eat 5 times a week. Really didn't bring us much happiness at all. So those are things we cut right away, made meals at home. We get to do stuff together, spend more time in the house together instead of going and eating some garbage out, and then spending on things that just you're passionate about, like identifying those. So for us, it's travel. We have a whole fund, $150 a week goes into a travel fund. And that fund is only, and I love it now because it's high yield savings account. We're getting like 5% on the money, but the only thing that we use that fund for is to travel. And we just went to Ireland in June and we used money from that. Like that is what so we love traveling. So we'll cut mercilessly, we'll cut money on those things that just don't bring us like pleasure or the highest pleasure and joy for us personally. And for everybody, it's going to be different. So you know, watching, you may hate travel, but you got to know what it is. So you can't cut on those things that bring you just joy and happiness because you never know how much time you have left on the spinning blue ball that we're on. So those are just some of the steps. And that's it. It's not very complicated. Oh, by the way, dude, you got a video called The Simple Path to Wealth.
Yeah. It's something that's the idea behind it. I don't remember what I called it, to be honest, but it's basically, I wrote one talking about like 10 rules that you need to, as far as investing. And like one of the rules in there is keeping your emotions out of it. I think that's very beneficial to being a successful investor, not just dividend investing in general, but investing. And then the other one I wrote is kind of the guide of that one is basically, I haven't seen it done like this. It's splitting it based on your end goal, whether you want to retire early and the steps that you should take to get to an early retirement and what you should do in what order. And then vice versa. If you want to retire at a normal age, which I don't know, 65, the steps you should take in what order you should take those steps to get to that goal. So that's kind of like the path to retirement, path to wealth that I was talking about in there. I know there's a book called The Simple Path to Wealth, isn't there?
Yeah, that's what I was going to say. You got to be careful there because that's like a famous book J.L. Collins wrote, The Simple Path to Wealth.
Yeah, no. Yeah, no, it wasn't like that. And it was, that was just one, because I'm on the path of, I want to retire before 65, before 59 and a half too. So like to me, it doesn't make sense to put a vast majority of my money in a 401k because I can't touch that until afterwards anyway. So it's kind of one of those things where I outline that. I'm like, okay, here's how you'd want to do it if you're, going towards the normal path. But if you're going towards this other path, you might want to consider switching some of these steps because it doesn't make sense to do that. So
Right.
it was kind of one of those things. But yeah, anywho, I don't have anything else to speak about. And if you don't have anything else at all, we can go ahead and wrap this up. You can tell the people where they can find you. I think you have a blog. I know you have the YouTube channel, which is great. I highly recommend watching that. So go ahead and tell the people where they can find you.
Yeah, so I got, at RustyRam78 on X. I got dapper-dividends.com. That's the website. I got a podcast that I do. You can find anywhere. I got the YouTube channel. And then I also have a weekly newsletter I put out. So you can sign up for that at dapper-dividends.com. Free weekly newsletter. So
Gotta love that.
those are some of the things. Any podcast, whatever your podcatcher of choice is, you can find that podcast there.
And what's the name of that?
Dapper Dividends.
Okay.
Yeah, so it's got the skeleton guy in the top hat.
Did you have any problems getting that name for all your stuff?
No.
Lucky you.
I just picked it out of the blue. I don't know why. It
there
just
you go.
Sounded good.
Yeah, there you go.
So thankfully nobody's called it Diaper Dividends yet. We're gonna
that's your new series when you're retired still doing YouTube. It's the Diaper Dividend Show.
Oh, believe me. Yeah.
That'll be good. That's good. But yeah, anyway, Rusty, Russ, I really appreciate you taking time to speak with me today. I had a blast speaking with you. I hope somebody was able to take something out of the conversation. I hope on Monday you can sell your AT&T stock and begin your new journey to financial independence with something that's going to make you money. And
yeah, we'll see. Old habits die hard. I hope you people, dude, when you do your intro, you got to tell everyone, listen, tell them I told you to put this on 1.25x because we'll both sound smarter.
Yeah, there you go.
Put an eggplant emoji if you're still watching it.
Yeah, there you go. Hey, I appreciate it, man. Thank you.
Absolutely, man. Take care.
And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time,